Okay, so for our agreed upon procedures example, we're going to be dealing with Alpha Advisors. Now, Alpha Advisors is a consulting company. It's a growth company doing well, and they're looking to take out a loan. So they've approached Good Times Bank to say, hey, we need some money to help fund our growth. Now, the bank says, that's great. We'd love to loan you the money, but we need some security. We want to have some collateral against the loan. Now, the problem is that, again, Alpha Advisors is a consulting company. They're not a manufacturer. They don't have a large volume of inventory or fixed assets to pledge as collateral. So Alpha Advisors comes forth and says, look, the only asset of significance that we have that we think we can use is our accounts receivable. We'd like to use that as the collateral. And the bank says, well, that's acceptable to us. However, we want to perform some verification procedures to ensure those receivables are in fact legitimate before we give you the loan. So the bank says, here's what we want. We want the consulting company, we want Alpha, to engage a CPA to perform an agreed upon procedures engagement. And Alpha says no problem, and they approach Becker CPA firm to do that work. So the bank and the consulting company here have agreed to 4 specific procedures to complete. First, basically check the math. Ensure that the AR subledger agrees it's mathematically accurate, it foots out properly, and second, that it agrees in turn to the general ledger and in turn the financial statements. Basically saying, yes, this detailed report is mathematically accurate, and yes, whatever it totals out to is what's being reflected on the financial statements, basically the number we're being shown for collateral. Third, the bank wants them to look at all large invoices, anything above $100,000, and they want them to do some trace testing to ensure that there's documentation on the name, invoice amount, and date on the actual invoice. For any other invoices, they don't want to just ignore those. They say, well, all we really want you to do is double check the aging. We want to make sure that it's in the appropriate aging bucket, because really the collectability of accounts receivable in large part is based on its age. That report should then be provided back to the bank and the consulting company. But that was a lot of facts, and I think a picture's worth 1,000 words, so let's do it graphically for a moment. So you see the 3 players here. We have Alpha Advisors, that's our consulting agency. We have Good Times Bank, that's the loan provider. And we have Becker CPA, that's the auditor. Now let's connect the dots between those players. First off, Alpha Advisor wants the loan from the bank. So we see the loan going from the bank to Alpha Advisors. The bank says, well, in return, we want you to pledge your accounts receivable to us as collateral for the loan. The bank's willing to accept that only if they hire someone to perform a list of agreed upon procedures. So that list is provided to Becker CPA. Upon completion of that work, the agreed upon procedures report will then be provided both to Alpha Advisors and to Good Times Bank. So this gives you an idea of some of the questions you would be expected to answer or could see on the exam. So who's the client here? Well, in this case, it's the client of Becker, right? They're the ones that hired Becker. That's Alpha Advisors, the consulting company. Who has to be independent? Well, although there's no assurance being given, that makes it a little unusual. Becker has to be independent. Part of the nature of an agreed upon procedures engagement is we're trying to get someone who's an outsider, a third party with no vested interest to perform these procedures objectively. Third, who agreed to those procedures? Well, the bank and the advisor company did. Were the procedures measurable? It's important. A firm cannot take on an agreed upon procedures engagement unless they believe that whatever they're being asked to test can be objectively and consistently measured. And the good news is, yes, the procedures were quite specific in terms of the size. It didn't just say, we want you to test big receivables or not test small ones. It set a specific threshold of $100,000. The procedures were very clearly delineated, so we shouldn't have an issue there. Who's responsible for the sufficiency? Well, it's the parties that agreed to the procedures in the first place, meaning it's not to Becker's need that they have to say, well, we don't think that'll do the job. If the bank feels it's sufficient and the advisory company said that's okay with us, that's sufficient. That's all that's needed to determine sufficiency. Who should the report be restricted to? Well, in this case, whoever needs it and whoever wants it is the 2 parties that hired the firm, and that's all. So it can only go to Alpha Advisors and the bank. And finally, who's the responsible party? Well, that's still Alpha Advisors. They're the ones presenting those receivables and stating they're accurate, so they're the ones that are ultimately responsible for the information on which the testing is being performed.